Hello and welcome to Fidelity Connects. I'm Pamela Ritchie. After the U.S. government shutdown delayed a key economic indicator, September's CPI report is out. The latest U.S. inflation data came in softer than expected, but building the case for more Fed cuts. Following the report's release, we saw equity markets rallying and the U.S. 10-year note fell below 4%, just below. With everything going on in the markets, our next guest highlights that there is still attractive yields and fixed income, and it's still an area that you may not want to overlook. Where is Canada's place in all of this, and how might it impact Canada's market environment? Joining us here today to unpack the fixed income landscape is fixed income portfolio manager Tella. Warm welcome to you, Shri. How are you?
I'm great, thanks. Good to see you.
Good to see you as well. It looks like there's some lovely leaves in your background. You've got that sort of fall look. Yeah, it's really, really nice. And you are a Blue Jays fan. You're a Canuck, actually. You're in the Boston area, but you're a Canuck. Is the Blue Jays your team?
Yeah, so I grew up an Expos fan. So having grown up in Ottawa, I was close to Montreal. And so it was a sad day when they left. But of course, with the Blue Jays now being Canada's team, I'm 100% behind them. So today was a really important day, not because of CPI this morning, but because it's the first game of the World Series. So I'm looking forward to that.
We know you have your popcorn and peanuts ready. So, okay, fantastic. All right, let's talk about bonds here and get into the discussion of CPI. I'll ask you about that to sort of pick it apart a bit and what you did like about it. But the idea through the last week and probably going into next week, we've got a Fed announcement. We've got tons of geopolitical discussions. I mean, the so-called event risk, but really it's statements being made about tariffs, about trade. We've got a huge U.S. China meeting. It looks like a Canada-China meeting at the end of next week. What do you do with these announcements that, in theory, could throw the market in either which way?
Yeah, I mean, I think the key is to always sort of have a longer term outlook and when you're thinking about investing. And so thinking about the impacts of all of these headlines. Oftentimes, headlines can have a negative impact, especially given where valuations are now. And that can be tough in the short term, but we view that as actually providing opportunity. It gives you an opportunity to enter the market or add risk at points where valuations become more attractive. And so the key right now is really thinking about the headlines, what is really more posturing and negotiating tactics that are out there versus what could have a longer term impact on fundamentals and the economy and pricing in the markets. And so really we're looking for headline volatility to actually provide opportunity for us to either add risk or reposition the portfolio to areas that look more attractive.
When you see the barbs being shared about the trade negotiations with Canada, U.S.-Canada, there have been some more of those in the last 24 hours, but there are often those. Does that provide an opportunity? Do you find markets are reacting?
Yeah, I mean, I think it can. The big thing right now is a lot of the markets kind of evolved into knowing that a lot of this is negotiating tactics and posturing. And so while we, back at the early part of this year, a lot of these headlines would have had a much bigger impact. It seems like the market's starting to look through a lot of this until they determine what the longer term implications are. And so I think there can be opportunities from time to time, and then on any given day, you might find one or two sort of hidden gems that sort of present themselves. But we're finding more and more that a lot of the headline posturing is not having as long-lasting an impact in the markets as we may have earlier this year, like back in April, where even then there was opportunity and we took advantage of that. But even then it was fairly short-lived as sort of Trump's rhetoric sort of flip-flopped and headlines changed from one day to the next.
I mean, there's been this thought of resilience in sort of the economic ability for Canada to power through here amidst a barrage of trade war worries, basically. From your perspective, from an investment perspective, Canada's doing okay. Do you see that as something that continues? Are there particular pieces of so-called event risk in the next, I don't know, few months that either worry you or present opportunities?
Yeah, I mean, I think if we kind of look back at the past year, the early part of the year was characterized by better than expected growth. And you could sort of point to a couple of things. One, you had the Bank of Canada that was very aggressive in cutting rates, and that provided a support to the economy. And then you also had an element of front running of tariffs that boosted activity and trade activity, et cetera, in the early part of the year. And then the second quarter kind of characterized with sort of a turnaround and starting to see some of the impacts of not just tariffs, but uncertainty, changes in immigration policy that slowed down population growth. So we did see negative growth in the second quarter. The third quarter is expected to be a little bit more sideways, but if you look back and think about the amount of cuts that the Bank of Canada has put in place, the easing of financial conditions because of the strength of the markets, and a number of other factors, and even a more competitive exchange rate from Canada's perspective, those are all have supported the market. But what I will say is that the economic prices have come in more negative more recently in Canada. We've seen the labor market soften up a little bit, notwithstanding the last print. We've seen growth come down, retail sales slowing, and housing a little bit weaker. And so all of those things do point to a little bit more caution in the economy. And inflation has become a bit less of a focus in Canada. And so I think there is continued resilience, but given that there is some trade uncertainty and some cracks out there, that kind of does warrant some caution in terms of what the growth outlook looks like going forward.
The importance of bonds in one's portfolio has been actually a pretty interesting conversation this year. There's a discussion of things that are correlated and aren't correlated. For your audience here today, do you want to kind of go into that spot for bonds? I mean, gold has been competing. We know this. Also, alternatives like other types of strategies within a portfolio. Do you want to just kind of come back, replace us at the place for bonds at this moment, but always in a portfolio?
Yeah. I mean, as always, I think, it's all about thinking about overall asset allocation.
Yeah.
And fixed income is always going to have some role to play. Obviously, when rates were at zero, there was less of a compelling case to be made, given that you weren't really earning anything. But given where yields are now, even though we've actually come off sort of the peak in rates, overall yields still look attractive on a historical basis. When you look at credit spreads, they are trading at the tighter end of their historical ranges. But when you look at all-in yields, we're still kind of in the third quartile of sort of in terms of attractiveness of yields on a historical basis. And so I think you're going to earn that yield, and it also still provides some downside protection, because if risk markets do take a turn, you do have some scope for yields to rally, whether it be through additional cuts from the central banks or just sort of a safe haven trade. So that's something to think about. And you made the point about gold. I'm not a gold expert, but obviously it's been done very well. And even our asset allocation teams have advocated for an allocation to gold. But as a replacement to fixed income, something to keep in mind is that the fixed income has that element of in a poor risk, in a soft risk market, can add some protection. And on top of that, you earn some income by owning fixed income on a regular basis. And that's can't be necessarily be said about gold.
So let's go into the inflation report today. I mean, there's sort of its discussion within a government shutdown and why it's an important data point, because we aren't getting other ones. And maybe we'll just leave that to the side right now. The idea of where inflation is, if you're comfortable with it, because inflation, really upends, bad inflation can upend the story for bonds. And so what do you think of this number? Are you comfortable with, what's your call on inflation?
Yeah, in terms of the outlook for inflation, I guess, on the surface, inflation has come off its peak. It's obviously given cover for both the Bank of Canada and the Fed to start cutting rates again. But if you look at the underlying components in the, breaking down today's number, for example, shelter inflation was kind of the big driver of bringing down inflation, and it was also focused on a specific region in the U.S. in the South, and so that is something that has been anticipated, because when you look at rent data in the private sector and so on, rents have been softening, housing has been weaker, and so that's somewhat expected. But the magnitude of today's drop was a little more than expected than that would have been indicated by some of those other measures. And so there's a possible that it's just the volatility from one month to the next that could be offset. But then the big concern has obviously been the impact of tariffs. And when you think about the tariff pass-through into inflation, that's something that was actually a little negative in this print. We saw goods inflation actually rise in today's print, and you're starting to see it in components like apparel and so on, where some of that pass-through seems to be occurring. I think what's happened over the last little while is that companies have been reluctant to pass through pricing because they don't know the extent and how of tariffs and how long they're going to last, because policies keep changing from time to time, and we're still in a negotiating process. But as we get into next year, you could start to see companies that start to feel some pressure on cost increases and have to start passing that through to consumers. The question will be, will there be offsets, for example, like in energy or housing, that potentially offset that inflation? But the tariff risk is still something that is out there.
Because it hasn't really appeared. Sorry, I just want to say, because it hasn't really appeared. Is that so? It's something that's hanging out there to an extent.
Yes, yeah, and so, well, the thing is, it's felt like companies have been holding off in terms of increasing prices, but at some point they're going to start feeling the margin pressure. It's going to impact their bottom line, and so they'll have to start thinking about making those changes. So the flip side is, though, to date, the impacts of tariffs overall in an aggregate basis haven't been as bad as feared. So, even if you think about the case of Canada, there was fears that, the tariffs would equate to double-digit sort of percentage tariffs on goods. But when you look at it all in, we're probably looking at mid-single digits increases in tariffs on Canadian goods in aggregate. Now, obviously, there's specific sectors like steel and aluminum and lumber and autos initially. That's been softened a little bit more recently. But there are specific sectors impacted. But overall, in aggregate, so far, it's actually been relatively manageable.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
If you take a look at sort of the industries in Canada that you just mentioned, and also maybe let's go into positioning a little bit on kind of the corporate side of things, and then we'll also talk maybe a bit more about what you like about either provincials or sort of the government debt story. But there's been resilience in corporations as well. Tell us just a little bit about your positioning within the Canadian corporates market.
Yeah, so for the corporate sector, the tricky thing is that valuations across the board on a historical basis look pretty rich. We're trading at the tightest levels post-global financial crisis in both the corporate market as a whole and in most sectors for that matter. But obviously, when we're positioning, as I mentioned, because of the attractiveness of fixed income in general, we want to have some exposure and some yield and to generate income in a portfolio. So on a whole, our corporate exposure is actually at the lower end of our historical sort of risk exposure. And that's really because we're cognizant of the risk reward based on where valuations are. And so we want to leave ourselves a lot of dry powder to be able to add risk as we get any sort of volatile periods, like we did back in April, for example. When we think about specific sectors, so let's start sort of at a higher level. We actually like provincial bonds on the margin, especially in the long end of the market, the long end of the curve, and that's because of the compressed spreads, that how compressed corporates are to provincials. You know, all valuations are tight, but provincials will be a little bit more defensive and compared to corporates. And so we actually favor provincial bonds out the yield curve relative to long corporates. Where we do have our corporate exposure is in the short to intermediate part of the curve, where they're just more efficient. You have more protection against spread widening because of the coupon income, and the yield can offset a lot of that given the shorter duration. When we think about specific sectors, because of how compressed things are, we are generally focused more on more liquid and relatively higher quality sectors. So as in Canada, the banks make up 50% of the corporate market. That's a spot that, even though valuations are tight, we tend to have an overweight to because it's you're not really getting much extra spread or yield to go into sort of riskier sectors. The other couple sectors that we have favored are REITs. But when we do look at our REIT exposure, REIT spreads have actually been some of the biggest outperformers over the past couple of years. If we look at our actual exposures, it's in very specific names in the space that have better trajectories, more stable cash flows, focused on anchored tenants, et cetera. So that's another space. So those are probably the two sectors we have larger exposures to. When we look at moving into sort of the triple B space, we like the pipelines. Pipelines are probably kind of, when you compare to other triple B sectors, leverage is relatively high in the pipelines, but we're talking about large companies like Enbridge, TransCanada, Pembina Pipeline that have pretty stable cash flows. They have a lot of capex, but they're managing through that, and they've actually underperformed over the last little while compared to some of the other triple B sectors. So those are some examples of corporate sectors that we like. The telecoms have done really well, but there's a lot of that's being priced in now. They've been buying back debt, reducing leverage. And so that's been priced in. So that's actually been a good performer for us of late, but that's an area where we're maybe a little more cautious, and that's mostly due to valuations, not nothing to do with fundamentals.
That's really interesting. So, I mean, the opportunities that you might, or the moments that you might go looking for, are sort of the geopolitical story, which is kind of what we started out talking about, that could see things waver a little bit. I mean, the yield story for most of the investments that you're taking a look at in Canada, they're stable, they're not so risky. You mentioned the B area. How far down the line do you go there?
So it depends on our different mandates, but typically we're predominantly focused on investment grade. We do have some mandates that will go into the high yield space, but so we have some exposure to that. But when we start to go down, so back, I guess to take a step back, when we look at like these inflection points like COVID and where market opportunities present themselves, we're a little less discriminate about what we buy because the markets are attractive across the board, and you just want to get market risk on. But in an environment like this, we're much more methodical about the names we own in the portfolio. I shouldn't minimize. We're always obviously looking for names that we like and focus more on strong fundamentals. But in this environment, especially, we're thinking less about broad market risk and really more about specific names that we like. And so when we go down the quality spectrum and even into triple Bs is probably typically our sweet spot. But now when we look at our triple B exposures, there are very specific names. They're names that we think are very stable companies with strong fundamentals and strong cash flows, but just happen to maintain high leverage, which keeps their ratings in that triple B category. Or they're names that have a catalyst, either an improving credit story, tailwinds to their business, or improving cash flows and a potential ratings upgrade. And so those are kind of things we're focused on. In this environment of all, because of where valuations are, we are much more focused on those idiosyncratic exposures as opposed to broad market exposure.
So the trade discussion obviously is there. There's a Canadian budget, obviously, as you know, coming around the corner on the 4th of November. A number of sort of concepts and pieces have been announced, but the details are not there. Curious what, from an investment perspective, you'd like to see there, or what would be unhelpful if it cropped up in the budget. What broad strokes would you like to see? What does Canada need from an investor perspective?
Yeah, I mean, I think what's going to be interesting about this budget is that obviously it's been telegraphed that the deficit's likely going to come in much larger than previously announced. There's talk of it going anywhere from 1% of GDP to as high as 2.5–3%. And so I think the key will be for the government will be to balance sort of these long-term projects with also providing sort of short to medium term things that may be more tangible. Because the issue with longer term projects are probably from a long term perspective, infrastructure spending and developing or investing in sort of long term projects is probably a better thing in the long run. But obviously, there are also some headwinds being faced now with investment uncertainty and trade issues that will require some support to the public on a shorter term basis. And so the key will be looking at how that's balanced. But the bigger focus from a market standpoint is how big that deficit is going to be and how it's going to be funded. That's really what's going to impact how we think about positioning in the market in the near term. So Canada has the capacity to increase budgets increase its deficits because it's coming from a relatively strong spot relative to other G7 countries. And there's also, I would argue, a shortage of debt to fulfill the demand that there is in the Canadian market.
Is that in the long end, or is that where is that demand?
Yeah, I mean, it's generally more noticed in the long end. There's a lot of demand from sort of pension money and other sort of institutional investors for the long end, and the supply of long issuance. Other than the provinces, we're not really seeing enough long dated bond issuance, and so I think that might be welcome to some extent. Okay. So I think it's really how the government chooses to fund and what the size of the deficits are that will be a big focal point. And then also this notion of the government's talked about separating out its operating budget and its capital budget, and so what the breakdown is of that and will be important as well.
So the deficit itself, how obviously these big ideas are funded. I mean, early stages, they'll probably invest in things that are a bit closer to being shovels in the ground or shovel ready and so on. And then there'll be other bigger things. I mean, at what point could you take a look at, you mentioned pipelines. I mean, it's hard to know what's going to be announced and how that will come under the umbrella of companies or, other types of organizations. But could you invest in some of these bigger projects, or is that pretty far down the line?
Yeah, I mean, I think some of that will be a little further down the line, especially when you think about even if the government's able to reduce the red tape required to get approvals and move forward with projects, that's still going to take time before companies start to think about their investment plans and raising money for these projects. But one of the things we do pay attention to is what that sort of, so I was going to say pipeline for lack of a better word, but I'm not intended. The pipeline for issuance and raising money and how that looks does come into play. But generally, I think a lot of these companies have done a good job historically of managing that issuance and managing their leverage and thinking about the impact that they will have on their business going forward. And so, we would often actually see things like that as an opportunity if there was pressure on spreads because they're funding for projects that are going to be incrementally positive down the road, and they have a good path to deleveraging, they have a good funding plan, that often will create an opportunity for us to invest in names like that.
Would it be useful? We've seen the U.S. government, for instance, take direct equity stakes in certain companies that fit with their overall plans, and to develop, if we want to call this an industrial revolution, a lot of people are. In Canada, there's been discussion of maybe the pension funds with deep pockets get involved in some Canadian projects themselves. Again, would it be useful to sort of speeding things along, I guess is the question from your perspective?
Yeah, I think it definitely could. I mean, you did see an example of that in Canada with the TMX pipeline that the government fully invested in, right? And very well, the government bought it. And that, I mean, obviously they're still working through it, and it was an expensive project, but that could work out in the long run. I do think some of these, the idea of having large institutional investors like the pension funds join alongside, I think that would be helpful. I guess from our perspective in the public markets, that actually is a incremental negative because it takes, that's more the private funding, JV sort of approach to funding these projects. And it would theoretically takes the opportunity away from public sort of funds to invest in some of these projects. But that being said, I think it would be beneficial in terms of getting some of these projects off the ground and getting broader support. The one caveat being is I think that the federal government needs to find a way to make these opportunities look attractive to the pension funds, because obviously it's all great to say that the government's telling the pensions that they have to invest alongside, but of course you have to remember this is pensioners' money, and they need to be able to earn a good return that's competitive with where other places they can invest. And so those opportunities need to be made attractive enough for the pension plans to be on board.
Just a couple of final thoughts as we close out. Sri, just flows are good. There's demand, clearly, for fixed income. Maybe you can just make a comment on that. And just also, looking out for weakness and what that means ultimately for a bond investor. If people are worried in the economy, they might want to be in a more stable investment. So just sort of the flows and general caution, if you could just comment on those as we close out.
Yeah. In terms of flows, we have seen pretty significantly strong flows into fixed income broadly, both in the U.S. and in Canada. It's a combination of a couple of things. One, reallocation out of other asset classes that have done well. For example, rebalancing out of equities into fixed income because of how strong equities have been in order to keep sort of a more stable asset allocation mix. And then the other thing is just thinking about all-in yields and returns and sort of the still perceived sort of safe haven nature of fixed income, given the attractiveness of overall yields, money has come in. Now, those flows were probably even bigger when rates were, 50 basis points higher, but we continue to see money coming in on a regular basis into fixed income. And so I think that's partly what's been supportive of some of these valuations in the market, and we don't foresee that changing anytime soon. So not only do you have relatively decent fundamentals that support fixed income, but also the money coming in is a positive. Now,
on caution.
But in terms of caution, I think that we're looking at economic data that's come down, uncertainty that's continuing to exist. And so, I think while fixed income is attractive, you have to pick your spots on where you invest, and that's why we have sort of lower risk profile right now in our portfolios. We have a lot of dry powder, and we're being much more methodical in terms of picking where we invest that money. Okay. And but at the same time, yields look attractive, and so we want to make sure we stay invested.
It's a really interesting moment to be speaking with you, particularly about this and taking a look at the different mix of narratives within the bond market. Tella, thank you for joining us, and go Jays.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.